What if the biggest mistake in passive income investing is the thing most investors obsess over first? Dividend yield. Because the truth is brutal. A high yield can make you feel rich for a few quarters, while silently destroying your capital for the next decade. The investors who build real wealth rarely chase the biggest dividend today. They chase something far more powerful, a dividend that can keep growing for 20, 30, even 40 years. That is where true compounding begins. Most investors ask the wrong question. They ask, how much income can this stock pay me right now? But elite dividend growth investors ask something completely different. How much income could this business be paying me 10 years from now? That single shift in thinking changes everything. Because a company with durable free cash flow, a strong moat, disciplined payout ratios, and consistent dividend growth can transform a modest starting yield into an extraordinary passive income stream over time. That is the real power of yield on cost. In this episode, we are building the passive income portfolio I would personally construct from scratch today. Not a speculative portfolio, not a yield trap portfolio built on unsustainable payouts, a portfolio engineered for long-term income growth, capital preservation, and financial compounding across decades. If I were building this portfolio from zero, I would divide it into 3 distinct roles, each with a different purpose, each designed to strengthen the portfolio across decades. First, dividend growth engines. These are companies with relatively lower yields today, but exceptional long-term dividend growth potential. Businesses capable of compounding income at extraordinary rates over time. Microsoft and Visa fit this category well. They may not maximize income immediately, but they maximize future income power. Second, balanced compounders. These businesses offer a stronger starting yield, while still delivering healthy dividend growth. A combination of present income and long-term compounding. Home Depot is a strong example. The goal here is balance. Not maximum yield, not maximum growth, but durable income expansion over time. Third, income stabilizers. These companies prioritize resilience, defensive cash flows, reliable dividends, and stability during economic slowdowns. PepsiCo and Johnson & Johnson belong in this category. This structure matters because it avoids overdependence on one sector, one yield profile, or one economic cycle. And over long investment horizons, diversification inside dividend investing becomes a form of risk management. For investors who prefer a fund-based foundation, an ETF like SCHD can also serve as a diversified core. Its expense ratio is just 0.60%. And that matters more than most investors realize, because every basis point saved improves long-term compounding. Now we get to the core data, because dividend investing becomes far more powerful when you stop looking only at yield and start analyzing the underlying business quality. Microsoft, and ticker MSFT, currently offers a relatively low dividend yield, but its 5-year dividend growth rate is around 10.2%. That is not the profile of a high-yield stock. It is the profile of a free cash flow machine, a business capable of expanding shareholder income consistently without sacrificing balance sheet strength. Then there is Visa, ticker V. The current yield is even lower, around 0.79%, but the dividend growth rate sits near 15.4% over 5 years, while the payout ratio remains close to just 22%. That combination matters enormously, because low payout ratios create room for future dividend expansion, especially when paired with durable global payment infrastructure and strong operating margins. Next is Home Depot, ticker HD. Yield around 2.2%. 5-year dividend growth near 9.5%. Payout ratio around 60%. The business is more cyclical, but still operates as a serious dividend compounder, especially during long housing and consumer spending cycles. Then we move into the defensive layer of the portfolio. PepsiCo, ticker PEP. Current yield near 3.6%. 5-year dividend growth around 7.2%. The payout ratio is elevated, close to 79%. But the stability of global consumer demand helps support long-term income reliability. And finally, Johnson & Johnson, ticker J&J, yield around 2.3%. Payout ratio near 75%. This is not a hyper-growth dividend story. It is something different. durability, consistency, capital preservation. Johnson & Johnson also belongs to the broader tradition of the Dividend Aristocrats, where consistency matters more than excitement. And over decades, that consistency becomes extraordinarily valuable. Now let's project the logic. Assume a hypothetical $100,000 portfolio divided equally across these 5 stocks. The starting dividend income would not be extreme. That is intentional. The power comes from dividend growth. If the blended starting yield is roughly 2.1%, the portfolio begins with about $2,100 in annual dividend income. But if dividends grow at a blended rate between 7% and 9% annually, the income stream can potentially double in about 8 to 10 years. That is yield on cost. A 2.1% starting yield can become a 4%, 5%, or even 6% yield on cost over time, without buying a single additional share. Reinvested dividends can accelerate the outcome even further. This is why dividend kings, dividend aristocrats, and high-quality compounders matter. They turn time into an income engine. But there are risks. Microsoft and Visa may look expensive because investors are paying for quality and future growth. A premium Moat can still become a poor investment if bought at an unreasonable valuation. Home Depot is sensitive to housing cycles, consumer spending, and interest rates. Its dividend strength depends on earnings resilience. PepsiCo and Johnson & Johnson offer more current income, but their payout ratios require attention. A high payout ratio does not automatically mean danger, but it does reduce flexibility. This is where investors must avoid dividend traps. A high yield is not a strategy. A rising dividend supported by free cash flow is a strategy. The best passive income portfolios are not built by chasing today's largest payout. They are built by owning businesses that can keep paying, keep growing, and keep compounding. So the real question is this: would you rather own a portfolio with a high yield today, or a portfolio with a smaller yield that can continue growing for decades? Because for serious investors, that single decision defines the entire dividend strategy. Short-term income or long-term compounding, immediate gratification or expanding financial freedom over time. The investors who understand this difference often stop chasing yield entirely and start focusing on business quality, cash flow durability, and dividend growth consistency instead. Because in the end, the most powerful passive income portfolios are rarely the loudest. They are simply the most resilient. Now I want to hear your view. Comment below with the one dividend growth stock you would add to this portfolio and explain why. Not just the ticker, the reasoning behind it. Because the quality of the business matters far more than the size of the yield. And if you enjoyed this breakdown, subscribe for more institutional-style investing analysis focused on long-term wealth creation and dividend compounding. This video is for educational purposes only and is not financial advice. Always perform your own research and consult a qualified financial advisor before making investment decisions. Past performance does not guarantee future results. Passive income expansion visuals.